Hi, in this recording, I will present our 2020 article titled Replicating Anomalies, published at Review of Financial Studies. This is a joint paper with Kowei Ho and Chen Xue. In this article, we argue that most anomalies fail to hold up to currently acceptable standards for empirical asset pricing. In particular, we replicate the published anomalies literature with 452 anomaly variables. We find that 65% of them cannot clear the single test hurdle of t-value greater than or equal to 1.96. I should say the absolute p-value. Our test framework is designed such that we can control for microcaps. In particular, we use NYSE breakpoints and value-weighted decile returns. We form 10 deciles on each anomaly variable, and we calculate high minus low average return. If that average return is significant with the absolute p-value greater than or equal to 1.96, then we say that the anomaly has been replicated, otherwise it fails to be replicated. So that's 65% is simply for single test hurdle. If we use multiple testing hurdle instead, even if we let the microcaps run amok by using NYSE, Amex, and NASDAQ breakpoints, in particular, if we use equal weighted decile returns, it turns out the most anomalies still fail to replicate. In particular, more than half or 52% of the anomalies still fail to replicate, even if we allow microcaps to play around, if we adjust for multiple testing. So the 62% success rate, failure rate, and 52% failure rate are based on our extended sample through December 2016. And the results are similar if we stick with the original samples used by original authors. So in that case, 65 becomes 65.3%, and 52 even raises slightly to 56.2%. So the large-scale replication failure is not due to our extended sample period. It turns out the biggest casualty in our replication effort is in the trading frictions category. So in this category, we have collected in total 106 variables. It turns out 96% of them, 102 out of 106 variables, fail even the single test hurdle. So in other words, the high minus low average returns are not significant. Their t-value, absolute t-values are below 1.96. And even for anomalies that survive our replication, all right, and their economic magnitude is much smaller than originally reported. The outline of the presentation is as follows. I will first motivate our large-scale replication effort, and then I will describe our replicating procedures. We go through the list of 452 anomalies next, and then I will detail the replication results, and then before I conclude and describe a little bit the impact of our paper. Now, motivation. So the critique based on data mining has a long history in academic finance literature and dated at least back to Lon McKinley 1990 RFS article. More recently, Harvey, Liu, and Zhang 2016 emphasized the importance of multiple testing. So they compile a list of close to 300 anomalies, and they show that between 27 to 53% of the anomalies are likely false, depending on specific adjustment for multiple testing. They attribute the false findings to two publication biases. And first of all, it's been hard to publish a paper with essentially no result. Okay, the result is not strong. We fail to find anything, right? So non-result is really hard to get published. And then until recently, it has been difficult to publish replication studies, that a paper that simply focuses on replicating prior studies, right? So our culture is such that we don't emphasize on replication. For a long time, we don't emphasize on replication at all. We simply focus on identifying more novel results. So Harvey's 2017 presidential address talks about the complex agency problem in our publication business. The so-called p-hacking, basically, oftentimes it's probably even accepted to a certain degree that the researchers engage in sample selection criterion, different cuts of the sample, and they explore different test specifications until insignificant results become significant, or until boring results become earth-shattering, for example, and then that will overcome the first publication bias, because it was pretty hard to publish a non-result. And then p-hacking is a way, it's in a sense a rational individual's rational response to that incentive structure in academia. So here is a Bloomberg article by Peter Coy, dated April 6, 2017. It says investors always think they're getting ripped off, and here's why they may they may be correct. So so Coy talks about the damage of replication failure in investment management industry. So researchers have monops to twist in search for a price anomaly. They can vary the period, the set of securities under consideration. That's the sample selection thing I was talking about, or even the statistical method. Negative findings go in a file drawer and never get published, and positive ones get submitted to a journal or made into an ETF whose performance we rely on retirement. So, and the incentives in industry are pretty strong, because according to ETF GI, as of August 2018, it's like almost 3 years old data. So there is $680 billion worldwide invested in smart beta ETFs and ETPs. So the replication movement in science was launched by John P.A. Ioannidis. In 2005, Ioannidis published a famous article titled "Why Most Published Research Findings Are False." And his argument is actually pretty simple yet profound. His argument is basically a base rule. So, so he says that, look, even if the test of your the power of your test is high, let's say 80%, is pretty high-powered test. That means that simply due to sampling variation, 20% of the time your results will turn out different. Okay, and then if you add a little bit prior, if you add a little bit of author bias, what we call publication bias in the prior, and then suddenly it becomes your posterior, replication failure rate can easily surpass the 50% hurdle, and that's what Ioannidis calls most, define more than half as most, and then suddenly you are looking at more than half of the published research findings are false or cannot be replicated. And that's Ioannidis' argument. It's a simple analytical argument and turns out to be pretty powerful, provocative at the first, but lo and behold, in the 15 years or so since its publication, evidence on replication crisis problem, at least, has been documented across the diverse fields of science. So here is a figure, a graph from Baker 2016 article in Nature. So Nature conducted a survey of 1,576 scientists. So is there a replication crisis? It turns out 52% of the scientists surveyed say that yes, there exists a significant crisis. 38% said yes, there's a slight crisis. So we're talking about 90% of scientists surveyed believe there is a serious replication problem or reproducibility crisis. Okay, 7% say don't know, and 3% say everything's fine, no problem. Right? So the vast majority of the scientists believe there is a problem. It's a serious problem, I think. So a little bit more detailed, have you failed, again, part of the survey, have you failed to reproduce an experiment? Let's see, more than 85% of the chemists said, yes, we have failed to reproduce somebody else's experiment before. 65% of the chemists say, yes, we have failed to reproduce our own experiment before. Among the leading reasons, sources for the lack of replicability, so selective reporting is the most important reason. Okay, selective reporting can everybody's got publication bias in their mind, and it's really hard to publish a paper with weak results, and therefore everybody's incentive is that all else being equal, we would like to write a paper with stronger results or more dramatic results. So pressure to publish and low statistical power or poor analysis and not replicated enough in original lab. Selective reporting or pressure to publish, right? So these are the two leading causes for the lack of replicated for the replication process. So over the years, there have been high-profile replication failures. So back in Alice 2012, another article in Nature talked about. So these are two scientists at Amgen, okay, famous biomedical firm headquartered somewhere in California, Northern California. So they replicated 53 landmark studies in cancer research, oncology, and they managed to reproduce the results for only 6 studies, 6 out of 53. So the problem is not the light one, it's not the mild one. This is a serious problem in medical science. In psychology is another broad area in which replication has received a lot of attention. In addition to medical science, this is an article published 2015 in Science, signed by authored, open science collaboration. This is a group that consists of 270 researchers in psychology. They went ahead and replicated the 100 psychological studies published in 2010 in 3 of their leading journals. And let's see what they have. So the left panel reports the p-values. You see in the original studies, the vast majority of the p-values are below 5%. So like 97% of the studies are significant, report significance, and this is their replicated study. As you can see, I mean, the results are pretty wild, and they go all over the place. Okay, so this is actually the vast majority of the replicated p-values are not significant. In terms of the magnitude of the size, the size of the effect or magnitude of the effect, this is the original study. Okay, in the replicated study, the effect size is more than halved. Okay, and then on top of that, like more than 25% of the studies, the effect actually go the wrong way with the wrong sign. So bottom line is that they end up concluding replication is a serious business that deserves to be taken quite seriously. So back to Ioannidis' analytical argument. So Ioannidis argued that the author bias, the publication bias, okay, so the results are more likely to be false in a field in which samples are smaller, the effect size is smaller, there are many but fewer theoretically predicted relations, flexibility is greater in test designs, variable definitions, or test specifications, there are greater financial interest and biases, and more independent teams are involved. So we argue that most, if not all, of these conditions apply to the anomalies literature. In particular, our samples are not small, everything is relative, but on the other hand, our target is quite elusive, average return, right? It's our signal to noise ratio is just too low, and our samples oftentimes we often joke about we need another 100 years of data to nail down to shrink the standard errors on our expected return estimates. Our samples are small, lots of noise buried in our samples. The effect size are smaller. So again, depending on how you look at these things, and the high minus low average return spread, right? It's not really, especially relative to the realized average return. So again, the signal to noise ratio is small. There are many but fewer theoretically predicted relations. So again, the anomalous literature for a long time. So the classic CAPM is the only theoretical framework out there, but has been rejected a long time ago. For example, by Pharma French in 1992. All right, so the anomalous literature has been heavy-duty empirical, and so the investment line of work and the investment model tries to improve on things, but still it's a long way to go. All right, so many empirical relations have been explored, but quite a bit fewer theoretically predicted relations out there. Especially historically, the anomalous literature has been mostly empirical. The investment model has gained some traction only in the past 5 to 10 years or so. Flexibility is greater in design, variable definitions, and specifications. So in our study, this paper, Replicating Anomalies, we explore this issue in depth. There is indeed quite a bit of flexibility in research design, right? So how you define anomaly variable in cross-sectional regressions, what control variables to use, all these things ended up in your final product are not exactly random. So and then we're gonna take a meta perspective. We're gonna take a holistic perspective of how these things impact on the final set of results. The greater financial interest, did I mention $680 billion AUM? So there's quite a bit of a financial interest in this field. And more independent teams are involved. And indeed, our field is competitive, and although quite a bit of collaboration going on as well. So even among competing teams, but still, so the field is quite big with lots of independent teams. So bottom line is that so most of these conditions that Ioannidis warned us about seem to hold in the anomalous literature. Okay. So when we were going around presenting the paper and going through the journal process, we had to jump over all kinds of hoops about what exactly is replication, right? And people argue, look, you are not exactly doing what I was doing originally in my original publication. So, and how can you call that replication? Well, yes, it's kind of a replication. So the replication literature is fairly clear about that. And I'm citing a prominent article by Dan Hammermarsh, one of my Facebook friends. So very, very happy with that. So Dan talked about different definitions of replications. A pure replication, or oftentimes people call reproduction, is to make or do something again in exactly the same way. Statistical replication then argues that this is what you use different sample, but identical model and identical underlying population, and then views this only marginally relevant for us. So, and then he then goes on to define scientific replication. This is different sample, different population, perhaps similar but not identical model, empirical setup, empirical design, similar but not identical empirical design. So, and then goes on and say, this appears much more suited in type to our methods of research, and indeed comprises most of what economists view as replication. The bottom line is that unlike in natural sciences. So in finance, most of the time we are dealing with observational data, okay? And there's a small but growing, pretty important area of experimental economics. But the most of surprising studies we're dealing with observational data, okay? So in this case, and trying to make sure that our results are reliable, and you can you can then take them to the bank, and that requires us to do serious replication. So in the May 2017 issue of the AER, that issue has published 8 articles on replication. Is pretty much a progress report on replication in different fields like labor economics, development, one not the macro, one not. So all 8 articles use exactly our definition of replication. Okay, so basically this is a scientific replication. Okay, so in our practice, we're using different and the same sample, same population, same reputation, same population, because we're using the same data set, Chris CompuStat. We are using similar but not identical empirical design. We actually also reported identical empirical design, not all the way to the details, but in a broad sense. And for example, we reported the results with the equal weighted returns, as well as NYSE, Amex, and NASDAQ breakpoints, as well as cross-sectional regressions with the OLS. Okay, so in equal weighted portfolio sorts and the OLS in cross-sectional regressions assign pretty high weights, disproportionately large weights on microcaps. Okay. All right, so replicating procedures. So we wanna control for microcaps. So the way we do it is to form testing deciles with NYSE breakpoints and evaluated returns. We also emphasize univariate cross-section from cross-sectional regressions with weighted least squares. These are market weights, market equity as weights. Okay. So both Pharma 1998 and Pharma French 2008 emphasize the importance of controlling for microcaps. So, our sense is that in the subsequent literature, so their lesson has largely been, not taken as seriously as we should. There are many ways to overweight microcaps. So one very prominent, seemingly innocuous way is to use equal weighted returns in your portfolio sorts, oftentimes bundled with the NYSE, Amex, and NASDAQ breakpoints, but the equal weights are more important than NYSE, Amex, NASDAQ breakpoints, or not just NYSE breakpoints. So cross-sectional regressions with ordinary least square as opposed to weighted least square, and this is another a very common way of overweighting microcaps. So why microcaps are so dangerous? Okay, this is why. So in this table, we update table 1 in Pharma French 2008 through our sample. So you see that microcaps, in terms of average number of stocks, so has 2,365. That number amounts to about 60.7% of the total number of firms. On average, is 3,596. Okay, so their microcaps are very plentiful, abundant, but in terms of total market cap, it's only 3.2%. Okay, so it's tiny corner of the market. Okay, and they are, I'm not saying microcaps are not important, and so we have one paragraph of discussion saying, microcaps, what finance people say microcaps, economists say call small firms, small businesses, right? They actually employ the most people in the economy, so they are important. Small businesses are important for economic growth, but our point is that when it comes to investment management, investing, like the 3 2% of total market cap is quite limited when it comes to economic importance. On top of that, the microcaps have very large cross-sectional standard deviation of returns. You see 19.2, much higher than small stocks, cross-sectional dispersions. So bottom line is that if you mix everything up, if you mix microcaps with all the other stocks in the economy, if you form portfolios using all breakpoints, and then bottom line is that your extreme deciles are going to be populated by mostly by microcaps. Okay, and once you weight everything up using equal weights, and then basically your average return estimate is all contaminated by microcaps. So portfolio weights allocated to microcaps in terms of percent, right? So we have later on we'll see the detailed list. We have 6 categories of anomalies, but let's just look at the first column. This is throughout the economy. This is across all our 452 anomaly variables. So basically, if you do NYSE breakpoints and value-weighted returns, so on average, in the low lag, you are only allocating 7.2% portfolio weights to microcaps, right? On the other hand, if you do equal weights, still stick with NYSE breakpoints, and that portfolio weight to microcaps goes up to 55.2%, substantially higher. If you do all breakpoints, this NYSE, Amex, and NASDAQ breakpoints, and the equal weighted returns, you are looking at the 57. So breakpoints themselves are not, hugely important. It is really value versus equal weights. That is the single most important element. So there's a Farmer Macbeth weighted least square. So on average, only assign about the less than 4% portfolio weight to microcaps. But if you do OLS, ordinary least square in cross-sectional regressions, that portfolio weight jumps drastically to 54%, more than 54%. And the results are quite similar, quantitatively similar on the long, on the high end, on the long leg of high minus low portfolio. Bottom line is that value-weighted results, very limited portfolio weights to microcaps, equal weighted portfolio sorts, very high portfolio weight to microcaps. So accordingly, if you look at the investment capacity, okay, investment capacity, we have a detailed definition in the paper. So basically, you're gonna, if you assign a lot of portfolio weight on microcaps, at one point you're gonna buy, if you are doing the long end, if a microcap stock is in your long leg, right, you're gonna buy up all the outstanding shares, all right, for that stock, and you have no more shares to buy, and then that's your investment capacity. Right, and similar for the low end, for the short leg, you're gonna short sell all the available stock, available shares outstanding for a microcap, and then you cannot do any more. You cannot expand your investment capacity any further. The bottom line is that to have a sense, a dollar amount on this sense of portfolio weights, at the end of December 2016. So that's the end of our sample in that paper. So we see that for NYSE value weights, the investment capacity is actually pretty big. It's more than $2 trillion. Whereas if you do equal weights, all breakpoints and equal weights, it's only $21.9 billion. So it's basically all 2 orders of magnitude smaller. Look at the long end, it's quite similar. The difference is even more drastic. So $1.57 trillion investment capacity for value-weighted results, and the only $9.7 billion for equal-weighted results. So this is the investment capacity. So microcaps are very hard to take advantage of. So in practice, so that's why we keep saying in the economic importance for microcaps is just rather limited. So from an academic research point of view, and our sense is that we need to focus on the broad cross section, right, and try to figure out how the capital markets really work. And so I've been on quant Twitter only in the recent 3 to 4 years, and I believe practitioners, leading investment professionals, they already know this point. So this is not news to them. So that the microcaps cannot be traded, and so that the profits in microcaps, whatever anomalies in microcaps, are more apparent than real. All right, so let's look at our 452 anomalies. So we have 6 categories: momentum, value versus growth, investment, profitability, intangibles, and trading frictions. So that's the total number of anomalies. So momentum, so all the usual aspects are here. As usual suspects are here. This post-earnings announcement drift, earnings surprise, price momentum, industry momentum, and this forecast change. We also include, so we try to be really comprehensive. So we find right? So we study both finance and accounting literature. So Thomas and Zhang, this is Frank, this is not me. This is Frank at the Yale accounting. So tax expense surprise. Okay. So and also number of consecutive quarters with earnings increases. So some of variables are not very well known, but we have done an exhausting search in the literature. Even the source is somewhat not very well known. We incorporated them. So a famous article, George and Huang, 52-week high, segment momentum, newer entries in the momentum category, residual momentum, customer momentum, and Kuwait's industry lag effect, and supplier and the customer industries momentum. So value versus growth. So book to market, Asnes Rosini's book to current market equity. All right. So and June end, as well as monthly sorted, using more up-to-date book to market. So financial leverage, market leverage, and deep on failures, long-term reversal, and over the famous overreaction anomaly back in 1985. Extremely influential article. The contract provisioning, cash flow to price, sales growth. The two mechanics, Justin Roberts. So this is payout yield, net payout yield. Yeah, already mentioned the LSV's sales growth, 5-year sales growth. So Tim and Jay's enterprise multiple being replicated very well. A shout out to Jay. Operating cash flow to price. Franco and Lee's intrinsic value to market. Different versions of them. Different versions of this variable. So enterprise book to price and the net debt to price. This is Pem and co-authors net debt to price, equity duration, D. Chancellor Solomon, and Laporta's long-term analyst growth forecasts. So investment category, we included pretty influential famous paper by Titman Wei and Xie, Abnormal Corporate Investment. That's the first article in the finance literature that talks about investment. So in Kuppen, Gould, and Shio, that's the asset growth paper that everybody's building on for their factor models. So, NOA, net operating assets, net stock issues. So Yuhang Xing's investment growth, and Fairfield and co-authors basically change in long-term net operating assets. That seems to be the first paper in the accounting literature that talked about the investment effect. Daniel Titman's composite equity issues. Total accruals, famous article by Richardson, Sloan, Solomon, Tuna, and Sloan's famous operating accrual anomaly. And different components of total accruals, they're all here. Discretionary accruals. Profitability, ROE, ROA that Kowe and Chen have been using since our Q factor paper. Mark Solomon's DuPont analysis, profit margin and asset growth that form a decomposition of ROA and ROE. asset turnover, and operating profitability. This is from a French 2015 version paper's profitability factor, RMW. So Raybo and co-authors cash-based operating profitability, Piachowski's famous F score. So failure probability, okay, Z score and credit ratings, book leverage. We put book leverage there because it's a from this is the one component of ROA actually. So we call it profitability and quarterly sales growth. Intangibles, this is a large category. So with the organizational capital, advertisement, R&D, different versions of R&D, including R&D to market, that turns out to be a pretty strong predictor. And we also added the broadly defined. So it's not exact intangible per se, but I'm open to that. But we are open to that. Firm age, price delay. So we could probably equally allocate this variable to the trading frictions category. So analyst coverage, effect tax rate, financing constraints, earnings quality, different aspect of it, corporate governance, earnings quality, persistence, predictability, smoothness, timeless, conservatism. Again, different versions of it. Asset liquidity, okay, dispersion of analyst forecasts. So these are all fairly well-known variables. And seasonality, big shout out every time I present this paper. So I, cannot stop praising Hester and Subka paper. So the 2008 seasonality paper, and they have come up with the seemingly very strange variables, seasonality variables. Basically, you can forecast returns, future returns based on 16 to 20 years lagged returns. Okay, we managed to replicate most of them, if not all of them. I think pretty much all of these variables are being replicated in our pretty tough replication effort and in other work, and we show that none of the leading factor models can do anything about this seasonality anomalies. So this is a really awesome paper. So the Hester and Subka paper is really pretty high quality piece of empirical work. So the last category is trading frictions. So I believe that's a typo. So we have 106 variables. We added a few later on. So we have 106 trading frictions variables. We replicated so 1 or 2 of them failed to replicate. So the size, idiosyncratic volatility, total volatility, systematic volatility, and different versions of beta, short-term reversal and turnover, dollar trading volume, share price at 0 trading days, maximum daily return, different versions of skewness, different versions of liquidity betas, okay, and however you measure, and tail risk and financial leverage beta. Again, another version of liquidity beta and the probability of insider trading, right? So it's pretty, again, 452. So it took a while for us to code everything up, and Chen Xue is really the hero behind this paper. So he should receive the vast of the credit in this paper. So big shout out to Chen. So replication results. So let's look at the bird's eye view of the replication rates. This is the success rates. So let's look at the single test. This is we have one bar overlay on top of another. So because multiple test bars are always lower, so it's only 1/2. So the single test, if you look at NYC value weights, you get the success rate only in 35% of the anomalies are being replicated. So this is the extended sample through December 2016. Okay, So multiple, if you adjust for multiple testing using the single 5%, just heuristically, just using 2.78 instead of 1.96, the success rate of replication drops to about 18%. Right? So if you look at all breakpoints and equal weighted returns, so 58.6% of the anomalies cannot be replicated. But now if you adjust for multiple testing, less than 1/2 of the anomalies still fail. Okay, so that's why we say most anomalies still fail to replicate once we adjust for multiple testing, even if we allow microcaps to run amok. Using cross-sectional regressions, the results are fairly similar. The results are also quite similar in the right panel, which is based on original sample in the original studies that we replicate. So again, 34.7% versus 35, so fairly similar. Okay, so 16.4, slightly lower than 18%, but again, generally speaking, the results are quite similar, the replication results. So each category, momentum and momentum category replicates reasonably well. More than 63% of the momentum anomalies are being replicated. So value at the time, so we actually had the 42%. This is the end of 2016. Now later on, each time we update our global Q factors data library, we lose more and more value versus growth anomalies. Okay, so this replication rate has dropped a lot in the past 2-3 years. Okay, so investment category has been doing well also, slightly less than 74%. But my understanding is that the investment factor is not as bad as the value factor, but my understanding is that it's been earning negative returns in the past 3 years or so also. So profitability, 44% replication rate. So intangible, so only slightly above 25%. So this result is really a shocker to us. Okay, so only 3.8% of the trading frictions category can be replicated. So 102 out of 106 variables in this category fail to replicate. So this is very shocking to us. So I remember when Kuwei Chen and we were revising our Q factor paper at the RFS. At the time, we only had we coded up 80 variables, including 13 trading frictions variables. We find 12 of them are insignificant. Only one of them are significant once we use value-weighted returns. So, and it was like, So the editor wants us to highlight that piece of evidence. This seems to be pointing to replication failure. And we were like, okay, so we did point out that point, but we ended up emphasizing the new factor model more. And at the time we were thinking maybe we had the selection bias. Maybe we just stumbled onto a finite sample of only 13 variables. All right, so maybe the universe is too small to begin with. Now this time around, when writing replicating anomalies paper, we expanded big time to 106, and the evidence remains quite similar. So this is a big shocker to us. So I should say that we're not saying liquidity costs, transaction costs are not important. Okay, not at all. What we are saying is that when it comes to generating factor premiums, investment and profitability and momentum and value, despite its weakness in the past, in the past decade or so. So when it comes to generating factor premiums, like economic fundamentals, like investment and profitability, are just much more powerful in generating factor premiums than trading frictions variables, especially in the broad universe with 97% of the total market cap. And that's our point. Right, so let's look at the individual papers, individual anomalies that are not being replicated. So I should mention before I start to go through specific examples, I think the evidence is important, and I should mention that both Kuwait's name and my name show up in, I believe, table 3, in which reported all the individual anomalies, including those not being replicated. So this exercise is as much of self-criticisms as criticisms on the existing literature. Our goal is really just to, tidy up the scientific record. Especially, I grew up from a theoretical background. That when we go out and construct a theoretical model, we really want to tackle reliable patterns in the real world, as opposed to patterns that due to special problematic empirical methods. And that's really our thinking. We just wanna solidify the scientific record. And on top of that, when writing up the paper, we've been careful that we try to be generous in the sense that we emphasize like changes in the objective data sources, for example, for the reason of our lack of replication. And on top of that, the writing is structured such that is our way of paying our respect to some of the most famous authors in the profession. All right, so with that, so bottom line is that it turns out that a post-earnings announcement drift is only significant in the 1-month holding period. 6-month and 12-month holding period is actually insignificant. Okay. So, and whereas in the famous change of conditional construct 96 Journal of Finance paper, so the number is fairly big. It's like 1.13% per month, but that's based on equal weights. Okay, lots of microcaps floating around. So RS, I believe, is sales surprise. SUE is earnings surprise. This is on sales. So they were reporting 73 basis points per month using equal weights. So we find only 15 basis points per month of t-value slightly above 1, and this is in value-weighted returns. So Thomas and Zhang, so this tax expense momentum, they report 1.3% per month, fairly large magnitude of anomaly, equal weighted returns. Whereas in our setting, using equal weighted returns, the results are fairly notwithstanding are fairly not that impressive. In this unimpressive, basically only 23, 24 basis points per month, and t-value is below 1.7 across different horizons. So value versus growth, the famous LSV, the construct initially, this is sales growth, 5-year sales growth rank. So we are only looking at, we only have 19 basis points per month. The t-value is slightly above 1. They were reporting 61 basis points per month. They were using equal weights at the time. It is oftentimes not using NASDAQ because NASDAQ was added relatively well, early 70s at the time was probably okay, certainly defendable not to use NASDAQ, but they still ended up using equal weights. Laporta, so we believe, I mean, this long-term analyst forecast, we get pretty much 0, especially monthly sorts. So annual source, 13 basis points per month is like very close to 0. This is like very small, and t-value below 0.5. Was Laporta reporting 21% per annum, which amounts to 1.74 percent per month. So this is a big difference, and we attribute quite a bit of it to the change in the IBIS dataset that has been reported in the prior literature. So net debt to price, our numbers are small. Okay, they're not that big, not that impressive. At most, 28 basis points per month, p-value 1.5, slightly above. But the payment co-authors were reporting 73 basis points per month. So it's actually quite, based on my reading, it's quite commonplace in capital markets research and accounting to use equal weighted returns, and that I think maybe right, if we wanna emphasize economic importance a bit more in our anomaly portfolios, and probably we should consider at least also report value weighted results, not just hang our heads purely on equal weighted results with the big average returns, but may not be real. Investment anomaly. This is total accruals. So Richardson, Solomon, Tuna report 1.1% per month. So a little bit twist. They are not exactly equal weighting. They were equal weighting, but they were equal weighting across size adjusted returns. But the size portfolios being that used for adjustment, size portfolios are value weighted, but the adjusted return afterwards are being equal weighted across stocks in a portfolio. So bottom line is that is fairly close to just simply doing equal weighted returns. So that's the reason why our estimate is way smaller than theirs in terms of economic magnitude, because we value weight all our portfolio returns. And similarly, external finance, equity and total finance, and our estimates are fairly unimpressive, 29, 18 basis points, but the accounting study reported 1.3%. So it's a big, maybe it's a different strands of literature ended up following different social norms, but that's, so we think there's value to borrow insights from these different strands of literature. At the end of the day, we're all looking at the same data set. Profitability anomaly. So OPE is operating profitability, the variable that underlines RMW in Pharma French 2015. So RMW itself is significant because it's 2 by 3, has a little bit of equal weighting going on between average high, average robust minus average weak. Average high operating profitability portfolios minus average, that average across average high, that's actually a little bit of equal weighting going on. Okay, so but if we just do value weighting, even if we ended up using more extreme decile instead of just 2 by 3, 30, 40, 30 cutoff for RMW. It turns out that if we do value weight across the board, then it turns out that we are only looking at 27 basis points per month and insignificant. Piotrowski famous F-score, fundamental score. So in our setup, we're only looking at 29 basis points, p-value 1.1. And Piotrowski original study reported 1.96% per month, gigantic t-value. He was using equal weighted, and he was using a subsample of value stocks, and that's totally fine because he was trying to use fundamental information to pick out value stocks, high quality value stocks. But the equal weighting is much more important in generating that big number. We also detailed in our paper. We try to dig deeper. It turns out sampling variation has a role, important role to play in this replication failure as well. So, right. So failure probability, the original study reported 81 basis points per month, but we only have 39 basis points and insignificant. It turns out that 5 years before the start of their sample, and we stumbled on the evidence that the effect the high minus low failure probability portfolio strongly go the wrong way. It's like it actually earns 69 basis points per month. It turns out overall, it turns out the financial distress anomaly, we include distress within the profitability category because financial distress, so a major component is profitability. It turns out if you look at different versions, different measures of financial distress, so most of the, they're all insignificant. Some are stronger than others, but most of the time they're actually credit ratings, O score and Z score, they're fairly close to zero. Although I should say failure probability, even that estimate is insignificant, maybe 39 basis points deserves due attention as well, because but on the other hand, as we show in other work, it's a reflection of the ROE factor. So intangible anomalies, dispersion analysis forecast. So a famous paper by Dieter, Malloy, and Spina. So basically, they were reporting 79 basis points per month, and we have 19 basis points and insignificant p-value below 1. So corporate governance. So this result has nothing to do with microcaps. No matter what you do, and that number just won't be even go above 10 basis points per month. Okay. So, and we're not alone in reporting this evidence. And Zhang and co-authors have an earlier paper in this regard as well. So, so basically, corporate governance is not that related to cost of capital. So most likely corporate governance is related to Tobin skill, but just not that related to expect returns. Accrual quality as well. Okay, so we couldn't find much. Okay, 12 basis points per month, whereas the original study uses earnings to price ratio as a measure of cost of equity. But because earnings to price ratio tends to be highly persistent, right? That may screw up some of the significance in your t-values. So idiosyncratic volatility or different, or the low volatility anomaly, low risk anomaly. Okay, very influential. Lots of AUM being traded right now. Again, this is a broad field. We looked at 16 different versions, idiosyncratic and total and systematic volatility measures. We find that only 1 out of 16 is significant. That's systematic volatility, 49 basis points per month, 2.2 t-value, whereas all the rest are insignificant, although the sign is fairly consistently negative, but in terms of p-values, they're just noisy, okay? Whereas in the original study, at the 1 month horizon, so the original study did report quite a bit of high average return spreads, and we in our replication we find out that it's not actually due to microcaps. This low risk anomaly is quite fragile, as some other studies have pointed out. Turombadi, I believe, have a paper early on at the GFQA also pointed out this issue. So it turns out it's all due to breakpoints. The original study were using NYSE, Amex, NASDAQ breakpoints. So if we simply change to NYSE breakpoints, and all the high minus low average returns are going to be more than halved, right? So 1.06 to 0.52, that's more than halved. And total volatility as well, and 97 versus 39. Okay, 1.04 versus 49. So basically, right. And this is the only case we have reported that breakpoints have such a significant impact. So they were using value-weighted returns as well. So it turns out that we reported in the internet appendix, we also reported if you use all breakpoints and equal weighted returns. So this average return estimates are even weaker than what we reported here using value weighted returns. So this low risk anomaly, our sense is that it's quite fragile. So, feel free to continue trading on them, but at the end of the day, the signs are indeed negative. But on the other hand, keep in mind could be less reliable than you think. So the traditional liquidity and the market microstructure measures are basically non-existent in value-weighted returns. So 49 out of 50 are not replicated with value-weighted returns. So if we impose multiple testing, P-cut of 2.78 is 100%. There are lots of famous variables here. So dollar trading volume, price impact, 0 trading days, share price, short-term reversal, different versions of liquidity betas, okay, financial intermediary leverage beta, okay, and the probability of insider trading. So in the paper, we also reported the equal weighted results, and they do better, but not to the extent that one would feel comfortable. So Ioannidis says 80% replication rate is a desirable outcome. So I believe now I'm relying on my memory about the point estimates now. So I think we only achieved something like 60%. In some scenarios, even 40% within that range. So even with equal weighted results. All right, so why does the prior trading frictions literature, liquidity and market microstructure literature report different results? It turns out that the literature converges on a set of different research design as opposed to NYSE, breakpoints and value-weighted returns in portfolio sorts. So oftentimes people ended up using cross-sectional regressions with OLS regressions, pretty innocuous, but it turns out there's some hidden impact that the prior researchers may not be aware of. So right, so some of the papers are pretty highly cited, but right, and equal weighted results, and that number is fairly big. Equal weighted shorter reversal is 2%, close to 2% per month, and the value weighted result is only 27 basis points per month and insignificant. So basically, shorter reversal is only in microcaps, and 0 trading days as well. So financial intermediary leverage beta. The positive evidence reported in the paper, in the original paper, is based on using size, book to market, and momentum portfolio as basis assets, using factor mimicking portfolio. Okay, so basically, factor mimicking portfolio is in turn used to explain size and book to market and momentum testing portfolios. Okay, I should report that the original study already reported similar evidence that if you just look at the financial intermediary beta alone, the beta alone doesn't forecast returns or fairly weak. And we confirm their result, which they also report. So 39 basis points, 1.9 T value. But the bottom line is that in our view, the evidence they report should be interpreted with caution because, again, they were using factor mimicking portfolio formed on size of book to market and momentum to explain book to market and size of book to market and momentum testing portfolios. All right, so even for replicated anomalies, the economic magnitudes are much smaller than originally reported. So this is abnormal returns around the earnings announcement. You see the magnitude are way smaller. All right, so 98 versus 32% because all the prior estimates are based on equal weighted returns. So for momentum as well. So let me have a shout out to Zhang and Titman. So their famous momentum paper is one of the best paper that is being replicated, one of the best replicated papers. So they were reporting 1.1% per month. Although they were using equal weights, it turns out even if we switch to value weights, the estimate is 82 basis points per month, 3.5. So momentum is pretty reliable. Customer momentum, this is the newer version. The magnitude drops 1.6 to 0.78, although 0.78 is still fairly profitable. So cash flow to price, smaller. Right, so let me talk about the investment asset. This is the total asset growth. All breakpoints versus NYSE breakpoints, and turns out in this case, there's a big difference. 1.05 to 44 basis points. So this is the variable that is underlying the investment factor, underlying the Q factor model, as well as the CMA factor in the Farmer French version. So 1.05 versus 44, and in particular is even bigger in equal weights, 1.7. So so we want something most reliable, so we ended up using NYSE breakpoints and value weighted returns in our factor construction. So Sloan's famous accrual anomaly, 87 versus 27 basis points per month, still significant, just much smaller. Okay, so again, he was, as mentioned earlier, so equal weights across size adjusted returns, but the equal weights, I believe, is more important than size adjustment. So it's equal weighting that is doing. So that's, yeah, so bottom line is that economic magnitudes are much smaller than originally reported, even for anomalies that are replicated, that are significant in our replication. So before I conclude, let me briefly, I'm not going to spend a whole lot of time about it. So talk about the impact of our paper. So we are certainly happy to see this. We were just struggling to publish the paper. Took a while in terms of positioning, and then we stumbled on the replication point, and our paper was circulated as an NBER working paper in the morning of May 8th, 2017. By the afternoon, there's already a Bloomberg article talking about covering our paper. A new paper just took a huge shot at some of the world's hottest investments. So I believe he meant the low risk investments. A few days later, and the Wall Street Journal, James McIntosh, kindly enough to write an article covering our paper. Jason Swig as well. And a day later, Wes Gray wrote a paper a few months later, a reality check on stock market anomalies. So a couple of more articles on Bloomberg that talks about our work. In terms of Google Scholar sites, so we do pretty well. The paper was published only last year. So as of June 5th, 2021, we have collected 515 Google Scholar sites. In terms of Web of Science citations, we have already, Replicating Anomalies paper has already collected 48 sites. So this is one of the fastest cited papers that in my body of work. For the Q factor paper, for example, I remember the Q factor paper is my most cited paper. I remember during its first year post publication, the citing article, the number of citations, Web of Science sites for the Q factor paper is 26. For Replicating Anomalies, we have 48. So we are very grateful. We are very grateful for that. All right, so let me conclude. In this paper, we replicate the published anomalies literature with 452 anomaly variables. We document 65% of the anomalies cannot clear the single test hurdle of an absolute p-value greater than or equal to 1.96 with NYSE breakpoints and value weighted returns. even if we allow microcaps to run amok with equal weights, if we adjust for multiple testing, still 52% of the anomalies cannot replicate. The results are not due to our extended sample. In fact, the results are quite similar in the original samples, and these are the corresponding estimates of failure rates. Okay, fairly close. The biggest casualty in the trading frictions category is in the trading frictions category with 96% failure rate for the single test. So again, we are not saying market microstructure, liquidity, transaction cost or whatnot are not important. They are important, especially for a portfolio manager. But what we are saying is that from the perspective of generating factor premiums, so trading fractions are not in the same league as investment and profitability, right? So in this sense, we feel that economic fundamentals are more important than the frictions on the trading side in generating factor premiums, and that's what we meant. Even for replicating anomalies, the economic magnitude is much smaller than originally reported. So implications, we end up concluding that capital markets are more efficient than previously recognized. The anomalies literature seems to be exaggerated, and we hope to do our part in terms of solidifying the scientific literature on capital markets anomalies. We are not saying there are no anomalies. There are fairly reliable anomalies, okay, but they're just not that many. So bottom line is that anomalies are not created equal. Fundamentals seem more reliable than trading frictions in generating factor premiums, as already noted. And we argue that we argue that fellow researchers should control for microcaps carefully in order to focus on economic importance and the empirical and the statistical reliability of our empirical findings. So at this point, the asset pricing literature routinely controls for microcaps, but based on my reading, the capital markets research in accounting still mostly relies on equal weights. That may be some room to change. So finally, and take economic theory seriously, and Ioannidis argue that if you have ex-ante theoretical reasons why empirical finding patterns should show up, should appear in the real world, and then that's the replication rate for that finding is much better. So we argue that we should take economic theory more seriously. So there's a little bit of a afterthought, final thoughts on the social structure of science. I have recently started to explore philosophy of science, philosophy of economics literature. So a big strand of the literature in philosophy of science is sociology of science, the social structure of science. So Robert K. Merton's sociology of science, norms of science. So Merton talks about the 4 values that the researchers should have, ideally. Communalism, he says that, so our scientific findings are not, we do not own our scientific findings, but just part of the community. Okay, so for example, the Q factor model belongs to the field. So Kawei, Chen, and I, we do not own the Q factor model. We do get the recognition of the Q factor model every time our factor model gets cited. Okay, so, and that's our payoff. Okay, as researchers, and we work for the recognitions of our peers, and that's the form of the recognition, and we work for, we labor for more precisely, but we do not own our own research findings. Well, although we're responsible for them. Universalism, Merton argues that we should evaluate research findings based on purely scientific criteria, not interpersonal, not the personal criteria like race, gender, ethnicity and nationality, or whatnot, seniority, for example. So all those emergence views should not enter the evaluation of scientific merits. This interestedness, this one is a little bit of hard to enforce. And later on, my reading is that philosophers have, including sociologists, have backed away from that. From this, basically, well, it's really hard to implement this in asset pricing because our research can be used heavily in the industry. Lots of AUM we're talking about here. Asset under management. Organized skepticism is the most relevant social norm for replication, right? So science has structured community scrutiny. Science organizes structured, scrutiny. So because we should be skeptical on any published papers, right? So, and that's why we need to replicate prior studies to solidify scientific record in order to hopefully to ensure the healthy development of our science. David Hall, another big name philosopher of science. He also talks about the social structure of science, and his philosophy was natural philosophy of science. One of his most famous works is a book called The Science of Process. This book is fairly sophisticated. I don't pretend I understand a whole lot of it, but I appreciate the highlight, the summaries that I've been reading, and from the first few chapters of the book as well. David Hall argues that science is cooperative and competitive at the same time. So researchers were competing against one another, as well as we collaborate among ourselves. So scientists want others to use their ideas. In our case, we really would like our fellow researchers to use our Q factor model, and we did spend a whole lot of effort, and right. So first draft to last draft, and spent over 8 years. So lots of ups and downs, and I think it's a good piece of work, and really hope others can use it. So, but to use our idea, right, and others must replicate our results. If our results cannot be replicated, it should not be used. And I would be the first one to say, hey, if you cannot replicate some of my results, and some of my papers should not be recognized, or should not receive credit for that matter. So, however, there's also a lot of trust involved. And this is what David Hall calls community replication, because our research time is limited, right? So, when writing papers, I read papers directly relevant to a paper I'm writing very, very carefully. And when it gets really close, I really want to replicate their results. Right? So especially if I want to build a model on top of that, I really want to make sure my own work is sitting on solid ground, but there's no way I can replicate all the relevant papers, right? For somewhat tangentially related papers, we really rely on other researchers to do the replication for us. So as a whole, the scientific literature as a whole the development can be healthy. Okay, so in a sense, this is we align self-interests of individual researchers with the good of the science as a whole. So it's a little bit of like Adam Smith's invisible hand mechanism, the market mechanism at work that David Hall was talking about, and David Hall's natural philosophy of science. Bottom line is that replication is important. And that's the point I want to make. Thank you.